$1 equal to 100 rupees when?
If the crude sustains above $120 for 3 more months, you are in that territory of 95 plus.
I see comments saying, please bring Kishore Narne back. Because every episode that I posted after your episode, gold and silver kept going up. What is happening? What should be my asset allocation?
Roughly around 15% should be in gold.
I think last time you said it was 25%?
Yes.
So now we've reduced the gold exposure.
Gold prices should go up because it's a safe haven. But after the war, the gold prices didn't go up. In fact, they came down.
Shouldn't the gold price go up because of it?
The US is the largest supplier of oil. Whatever they did in Gulf, which led to the closure of Strait of Hormuz. So it's not the price now. It's $100, $120, whatever it is. But I need oil to run my factories.
Do you think that this war is America's way to distract the world from the real problems?
I don't think their leaders seem to be that smart.
So then how does this finally affect the stock market?
So
all right. Mr. Kishore Narne, welcome back to the 1% Club show.
Thank you.
Every episode that I have posted after your episode, I see comments saying, please bring Kishore Narne back. Because every episode that I posted after your episode, gold and silver kept going up.
Yeah.
And you mentioned in the podcast that you would not put your money in silver back then.
Yeah.
Do you regret saying that today?
No. Because
it has gone up almost 2x, 3x.
It went up, it came down also.
It came down also.
So I don't like that kind of volatility. But if a person likes that kind of a ride, so for example, if I'm scared of roller coasters, I don't want to sit.
Yeah.
But I don't say that nobody should be sitting in that, right? So if you like that and have fun.
Right. So I remember last time I spoke to you, you said that the rally of gold back then, when it was at 1 lakh rupees for 10 gram, when we spoke, you said that has surprised you also, it has shocked you also.
Yeah.
From then to now, has it shocked you even more? What is happening?
No, actually, when I told you that, it was the speed which shocked.
Yes.
It was not the price, it was the speed. So when we were telling that the price will come in next 18 months, it was coming in 3 months. So that's what the shocking factor is, not the price, but how fast the targets are getting achieved, how fast the movement is. But now currently everything slowed down. Right? It's
from then to now, from then to then, I think from then to a certain point in time, it had reached 1,60,000.
Yeah. So the final leg is what we call the FOMO. Right? Okay. The last leg of the people who missed out the rally, they actually came and entered last. I think if I remember, December 1st, 2025 was 1,80,000 rupees silver. And around $60 we did that podcast, and our target was around $95. And when 95 came, actually we said that that's our final, so we are not able to understand anything beyond that. But 95 to 120 came in a week or 10 days.
This is in silver?
That's in January, in silver in January. And it took only 10 days actually. It's around another 30-40% rally. And post the 1st February, which is the infamous Sunday, when Indian budget was there and the markets were open, and where the complete crash came down. So that's the last burnout which happened. But fundamentally and structurally, both gold and silver still are very strong. The froth which gets built up time to time in the markets has now disappeared. The froth is gone. So now we are in the clean markets. Again, it will take some time for the build-up to happen. So my take is right now, probably for another quarter, maybe till around May, June, we'll have very range-bound markets. Again, the broader fundamentals, which are the currency-related, de-dollarization, all those things will start kicking up, because there's a lot of noise right now. Because of the Gulf War, a lot of European issues, everything. There's a lot of noise right now. So I think these all things will settle down by around May, June.
Do you think that this war is America's way to distract the world from the real problems?
I don't think so. They have a lot of benefits from the war, and so I don't think they have planned it or not. So I don't know. I'm not privy to those informations. But actually, in a way, if I see, everything they did benefits US.
So it should be a plan, then.
Right. but I don't think their leaders seem to be that smart. But so today, whatever they did in Gulf, which has led to the closure of Strait of Hormuz, so the rest of the world is looking for the oil. So it's not the price now. It's $100, $120, and whatever it is. But I need oil to run my factories. So US is the largest supplier of oil. So they were saying India to buy oil from them, but it's not economical for us to get oil from such a far distance. So it doesn't make any sense. But now we are buying more oil from them, right? As part of the trade deal also, now as part of non-availability also, right? It benefits. At 120 they are selling, 110 they are selling. WTI is 96, 95, but still they're selling at much higher price. So they are getting the market share.
Where is it coming from? If the Strait of Hormuz is blocked from US to India, where is it coming
US
from?
to India, it can come from Suez Canal, no? So it doesn't come from Strait of Hormuz. Strait of Hormuz is only the Gulf oil. The Kuwait, Iran, Iraq, Qatar, Bahrain, and UAE and Saudi. So the Suez Canal route, so it comes to the Red Sea and comes there from the Gulf of Yemen.
So we are forced to buy from the US at a higher price. So this war has actually benefited the US.
Yeah, to some extent, to some relief that US has allowed us to import Russian oil now as part of easing the global prices. If not, the price would have been even further higher.
So how does that affect the common man when price of oil goes up? What can we expect to see?
Price of oil, currently the price of oil is a shock absorber, kind of a thing. It's just a shock currently, is the supply shock. There are two aspects for this. Okay, one is that at some point of time, not today, maybe at some point of time, all these things will settle down, cool down, Strait of Hormuz will open, all the oil will start flowing back. So the prices have to cool off. Before the war, the oil was trading around $60, $70 is typical range. Suddenly $60, $70 became $100 now. So whether once the war is done, whether the oil will go back to 60 or not is a significant debate right now going on in the market.
I think you only once told me that when oil prices increase, it's actually good because it creates GDP growth, real GDP growth because of inflation.
Yeah.
You only said
so for the Gulf countries, who are the exporting countries,
okay.
For them, it's the GDP. So it's part of the produce they produce, right?
Right.
So for countries like India, which is an importing country,
But it will create inflation for us, no? With the higher price.
So every if you just put in the math, every $10 increase in price takes away roughly around 10 bips of our 10 to 15 bips of our GDP.
GDP growth?
Yeah.
Okay.
So, and it actually causes you around 20 bips of inflation.
So inflation growth is more than the GDP reduction?
Yeah.
Okay.
Yeah. So, typically there are 2-3 things which happen if you are an importing country. One is your currency depreciates because you have to pay more dollars. So you'll be using your reserves or something like that. Second is that inflation goes up. All the commodities on the food, everything will go up because everything has input, as energy is input for everything. So that goes up. And overall, some of the money which is available to go for capital creation and for growth will go into consumption instead. So that actually hurts the growth also. And for us, because we are an importing country, current account deficit also widens further. It causes our interest rates to go up. So it has a multiple effect. But the effect
Why does interest rate go up because of this?
Because the inflation.
When inflation goes up?
When inflation goes up, the central bank will raise interest rates.
Why?
To control the
inflation.
To control the inflation.
Okay.
Yeah.
So then how does this affect the final market growth, the GDP growth? How does that finally affect the stock market?
Stock market is mostly earnings. Whether the companies are able to
make money.
The broader economic cycle is there or not. People are spending money.
So if the oil price is continuously high.
Yeah. So when energy prices goes up, generally it eats away from your discretionary spending.
Correct.
Right.
My petrol cost goes up.
Yeah.
LPG cost goes up.
Yeah. And also everything. For example, your food to your consumables, everything. Energy is an input.
Can you give an example of an everyday item which people don't know?
If you're growing corn or if you're just a farmer, so you're using your tractor, you're buying your diesel, you're buying your petrol. So you're transporting your laborers to your factory. From there, your power, your furnace, for example, if you are an iron and steel company, you're running a blast furnace, you're using furnace oil, which is again derivative of a crude oil. So your airfares are higher because again, that's an input cost for many of the companies, right? So your travel cost increases. Everything. So energy gets into everything.
It's the force multiplier for every cost that we have. So that will reduce consumption, which will slow down the economy, which will affect the stock market. So the longer this war continues, the more bad it's for India.
Yes.
But US is having a good time.
Yes, because US is an exporting country for crude.
So net exporting countries will benefit from this.
Yeah, because they have more places to sell their oil.
Okay. So right now, what should be my asset allocation? Like how much of money, of your personal money is in gold right now as a percentage?
Yeah, so always again, I see my heirloom gold or the ornaments, I don't see as an investment, so I keep it aside.
Yeah.
So typically, when you have a 100 rupees, let's say, if you have a portfolio, I still believe 50 rupees should be in equities at this point of time. Roughly around 15% or 15 rupees or out of 100 rupees should be in gold. 15 rupees, I would suggest to get the global exposure. So all the Indian resident Indians are allowed to invest in overseas markets through LRS route.
So right?
You can access US markets, you can access Taiwan, you can access Chinese markets, you can access multiple markets actually. And US is the easiest and
but would you suggest investing in
I would suggest 15% of your portfolio should have exposure to global markets, because that will give you an underlying and participation into this entire large AI boom which is going on, right? So
US
right
markets
now,
basically.
US markets. And roughly another 15% into debt. So that will bring you to around 95%, and 5% you should have always dry powder at this point of time. So you should have cash. So to grab any opportunity which might come.
So you mentioned 15% in gold. I think last time you said it was 25%, if I'm not wrong.
Yes.
So now you've reduced the gold exposure.
Yes.
Why is that?
So I'm actually increasing the global exposure instead of that. So one is that off late, especially one of the things which has happened post-war or once the war broke out, I've been receiving a lot of calls. So war is equal to gold prices should go up because it's a safe haven, right? But after the war, the gold prices didn't go up. Actually, in fact, they came down actually. So why is this happening? So a lot of people were asking me this question. So today, liquidity trumped the safety aspect. So liquidity is dollar. So globally, any fund manager wants to sell off his asset. The first thing he will take back is cash, right? So when you sell, you take cash. That's the dollar. So globally, liquidity means dollar. So today, everybody who is liquidating their assets will be taking dollars. So that dollar triumphed as a safe haven, the ultimate safe haven. And gold cannot do that. Actually, you cannot sell your equities, convert into gold because gold is not that such a large asset, especially the global large funds, especially the pension funds, hedge funds, family offices. The large ones always go back to cash, right? Cash is dollar. So,
but why are they going to
dollar
cash?
Because of the risk. What is risk averseness? So once I see risk, globally markets will fall. There is a significantly elevated risk environment. War risk is there. So the risk premiums are higher. So better to book some profits and get back and sit on cash.
As a retail investor today, we're all a single unit because we're all on social media. So if I see war is happening, like how your investors called you up, won't all retail investors think, okay, now let's put money in gold, war is happening. Shouldn't the gold price go up because of it?
Yes, that's been happening. That's where we see that a lot of gold ETFs in India has received significant amount of money.
Correct.
Now, today, the new money which is coming, almost 50% is coming into either multi-asset fund or gold and silver ETFs.
So if that is happening, shouldn't the gold price go up? If more and more people...
They have already gone up. So the incremental growth in that will have to happen. And suddenly, because see, already gold has rallied almost 100% in last 2 years.
Yes.
So from there, if it has to rally another 30-40%, you need triggers. Second, the gold is priced in a currency. So again, I think last time when we discussed, gold is no more a commodity, it's a currency.
Yeah.
A currency is like, currencies always are traded or quoted in pairs. For example, USD INR. So it's a price of $1 in Indian rupees, right? Or Euro USD. So it's one price of €1 in US dollars. Right? There are two currencies. One is a base currency. The other is called a quote currency, in which the price quote is happening. So gold is nothing but gold USD. It's XAU USD. We call it as that. So basically, gold price in dollars.
Okay.
So in a currency pair, for example, USD INR, which is the dollar rupee, right?
Which is 93 right now.
93, 94, 93, 92, 70 right now. So $1 is 92.70, right? So how this change? This is called exchange rate, right? This is not the price of dollar. This is not the price of rupee. This is the exchange rate of, if you have to convert your rupees into dollars or dollars into rupees, this is the exchange rate.
Okay.
Right? So how this exchange rate changes? Tomorrow, for example, it goes to 90, right? Either dollar loses its value or rupee appreciates its value.
So one question, if India does really well, how does the value of INR go up? Like, is it because the demand for INR is going up?
Yes, because there will be a lot of flows into India. People will, so for example, a foreign investor comes to India and to invest. What he brings dollars. He sells dollars into the market and buys rupee and invests the rupee.
Buys rupee matlab?
So he has to convert his dollars to rupee, right?
And then invest the rupee into the market.
Right. We don't take, so Indian stock market will not take dollars. They will take only rupees.
So he has to convert his dollar into INR, which increases the demand for INR, which makes the INR go.
And also increases the supply of dollar in the Indian market because they are selling dollars.
Right. And how does that help India if there is supply of dollars in India?
Because again, exchange rate move. From 93, it goes to 90. Because there are more dollars available, but dollars are not freely available in the market.
So the more
what happens is all the conversion happens through RBI. So RBI accumulates these dollars and gives the rupees.
So the more dollars we have in India, the lesser the dollar.
That's the forex reserves.
That's the forex reserve.
Yeah.
So the more dollars we have, the cheaper dollar gets for us.
It should be better for the economy. But at the same time, that also depends how your imports and exports are also there. So one is the cash flow. That's the capital flows which are happening. At the same time, trade flows are also there. So when the India grows, its demand for oil goes up. It demands for more imported commodities or goods or iPhones might go up. So that also actually puts pressure on the currency. So though your equity markets might be going, you might be attracting a lot of capital flows. At the same time, if you are consuming a lot of oil, that takes away the dollars.
Whenever the dollar INR goes up, there is usually political bashing happening that because of you, this is happening. But who is really controlling this?
But fundamentally, if you have to, your currency has to appreciate, right? You have to be able to deliver more to the world and take less from the world. It's as simple as that. You are one household, let's say, out of a village, and you are one household. You're contributing more to the village and you're taking less from the village, then you are actually richer and richer. Right? So you have to export more goods and services and consume less. That means I take less oil or something, whatever my imported commodities, then my currency value will appreciate.
So which country is doing this properly?
There is nothing called proper actually. In economics, what happens is you have choices. Okay. So at times you have to you have to pick your choices. For example, today, India's requirement is growth because we have a large population to feed. We have a large number of youth who needs employment. We need to create jobs. For that, we need capital. We need infrastructure, right? So we are a growing economy. A growing economy generally loses its current value. So when since 1990s and early 2000 to 2015, where massive Chinese growth was there, China has a massive currency depreciation happened. It's not a bad thing to happen.
Is it like
and in those times, if you remember, the US used to always blame China that artificially you're depreciating your currency and you're cheating me because you keep your labor cheap and you export cheap goods to me and you're consuming all my dollars. And so basically a weaker currency is not a bad thing necessarily, but at what cost? So there are choices. There is nothing called perfect.
Interesting. So you're saying that India, there's no right or wrong way.
Yeah.
India is a developing country, so it is important for us to be in a cash burn mode or cash deficit zone, so that we can reinvest in ourselves, bring in capital, and become a big country.
So I think exactly the thing which we were discussing before this, that as a startup today, you have to become bigger before you are knocked out. Right, that's where you need a lot of capital, and you are right now, as you mentioned, that why startups are burning capital, and this is a different way of doing business. This was not done the same way like 20 years back. It was different, right? So, can India become richer before it becomes older?
Can India become richer before it becomes older? Meaning before the population becomes...
Before the average age of Indian becomes older,
can it become richer?
Can you actually, the per capita income goes up to that $15,000, $20,000.
It's a given that aging will happen.
That will happen eventually. So that's why you have to grow faster.
Perfect. I think now we will move on to the rapid fire round. I'll ask you some quick questions. First one is, if you had to put all your money in US or China right now, where would you put?
I think US, because of ease of entering and ease of getting out. Because China still is difficult to get in, difficult to get out.
And if you could split your money between any different countries outside of India, which would be those countries?
So, US, of course, tops Taiwan and Japan. So, Taiwan
no China.
No China. China is still, it's not a freely entered, and its exit regulations are there. So, you can access Chinese market through some of the Hong Kong ETFs and all, but it's not still not a very freely... capital movement is not available. So, Taiwan, so of course, AI boom is still a big thing which I still bank on.
But why Japan? I understand US and Taiwan.
Japan is available at very, very cheap valuations. And Japanese currency also has deteriorated significantly. So, it's double benefit. So, it's cheap now. And I think Japan is coming up faster. So in the next couple of years, Japan will be much more better shape. Their policy response is better now. Second, Taiwan is, you get same AI. For example, you get NVIDIA here in US. Similarly, you can get Samsung or any other chip makers like TSMC is there in Taiwan, which is basically the manufacturer of NVIDIA chips. But at much cheaper valuations. You get Taiwan at 13 PE. Whereas US, if you go to Mag 7, the PE is around 22, 23. So the similar technology you'll get at 13 PE.
Right.
But Taiwan comes with a risk.
Why?
Tomorrow, at some point of time, this perceived risk is always there that China can do something in the South China Sea.
$1 equal to 100 rupees when?
Don't know, but I think 94, 95 is on the cards. If the crude sustains above $120 for 3 more months, you are in that territory of 95 plus.
One asset class you would completely avoid right now?
One asset class which I would avoid... see, technically I don't avoid, but bonds are something which, because the yields are going to go up, so bonds will fall. And there is a significant risk there. So, in all the bond markets. So, it's need to be...
Why is that? Because the yields are going... why the yields going?
So, as the inflation goes up, bonds will fall.
Bond price will start.
Bond prices will fall.
Interesting. What is the best hedge today?
The way I said you, there are 2 ways you can hedge. One is of course, you can buy some gold. That's as a hedge. Second is diversify into multiple economies rather than a single economy. Because then you are exposed to 2 different things. For example, if you keep entire your equity portfolio in India, so the all Indian problems will become your portfolio problems. So you can have a better country like US as some portion which will give you an offsetting hedge. At the same time, the newer technologies are there. You can encash them. And India is still a growth story. I don't have a problem with that. You might have another 6 months might be something you can have. But earnings turnaround will at some point of time will happen. Other than this crude and the Persian Gulf risk, I think we are time to rebound. So large cap Indian stocks, is a good bet to have, and some diversification into US equities.
You didn't mention Taiwan and Japan again. That's not a good
So again, I'm saying that step one is first you go to US. You have to evolve from there to
start with US and then go to Taiwan and then go to Japan.
Yeah.
Okay. Is the Indian stock market overvalued or undervalued right now?
Again, with the disclaimer that I'm not a stock analyst or a stock market expert, but see, we are at around 17 times or 18 times of 1 year forward PE.
Yeah.
See, around 14, 15 is a value buying.
Right.
So, we will, I think there's a lot of fall in the recent times. I don't know how these adjustments have happened. So, any time close to around 13, 14, 15 PE forward earnings, 1 year forward is a very good value proposition for India. And always India gave significant returns from that point. So, I think that will come somewhere in the close future. So at that time, India becomes highly attractive.
And one last bonus question. One book that you recently read, which you really liked.
I'm reading, I think, World for Sale.
World for Sale?
Yeah.
What is this?
It's about commodity traders globally, how they control global politics and economy, how the deals happen and all those things. It's been written by one of the Bloomberg's commodity editor. It's there with me now.
Okay. You read that while traveling.
Yeah.
And Mr. Kishore Narne, one last question or request from you is, if you could nominate a guest for my next episode, who would you nominate?
I think if you have to find good answers of wealth management, and I think Ashish Shankar, our MD CEO for private wealth management, is an excellent speaker. I think you should talk to him.
Definitely. Thank you so much, sir. I think it was once again a very enlightening conversation. Your knowledge is limitless, and I'm sure people would be begging for episode number 3. So when that day comes, I will call you back once again.
My pleasure. Enjoyed it, as always.
Thank you so much.
Thank you.
Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.